Hey everyone, Chris Lopez here, and today's episode is part of our deal analysis blitz. So, we'll be talking about a detached single family home that we bought as a rental property in Aurora. Now, I'm excited to talk about this because we often talk about condos and single family detached properties are usually the properties we buy the least of for rental properties. And so this is a a solid rental property with good numbers. So I'm excited to share it and also answer any questions out there. My co-host today is Preston Newberry, who's an agent with me at Denver Investment Real Estate, and we brought this deal together ourselves for our client. Preston, how's it going?
It's going great, Chris. Thanks for having me on. This, like you said, was something we don't do a whole lot of. So this was a fun and different project to work on, and I work with these clients to get this one under contract and get it closed for them.
And so if you guys follow our podcast or follow the Denver market, you know why we don't buy a lot of single family homes, and that's just because of the price point, or I should say the rent to the price point. So it has a lower cap rate. Generally speaking, single family homes have the lowest cap rates out of between multis and condos and townhomes. So obviously a important aspect of buying a rental property is making sure that you want to buy a lower price rental property, since rents are usually pretty much the same for a lot of the outskirts of town. So some of the lower price point detached properties around Denver is in North Aurora. And we really like around the Anschutz medical complex. So that's right, at 225 and Colfax, just because lots of homes around there, lower price points. And if you guys have driven that area, those hospitals have grown a lot. They put a lot of money in there, and they will change that area. So it's going to bring, more renters, more buyers, more businesses. And that should always have good demand and hopefully see lots of upside on the rents and also for price appreciation. Plus, a lot of the areas over there are in opportunity zones, which are those federally or those zones that get favorable federal tax treatment, where basically it's trying to drive big money into redeveloping the area. So for us and our clients, the mom and pop investors, we really can't take advantage of the opportunity zone tax credits. But what we can do is we can ride the coattails of the bigger investors who are putting in millions and tens of millions of dollars, ride their coattails and just let them change the neighborhood, and we can enjoy the price and rent appreciation while we're over there. So the investor profile for this property, they did not want an HOA. They are very familiar with HOAs and just did not want it. So they wanted a single family home. And like a lot of our clients, having strong cash flow today or maximizing cash flow today is not their main priority. They want a property that will pay for itself, but building a long-term retirement rental portfolio is their goal. And they wanted to have a property in Denver to avoid any out-of-state hassles. So these clients, I know they had looked at out-of-state, realized, hey, that wasn't for them, and they had tried working with some wholesalers, couldn't find any deals for them, and they said, hey, guys, we've just been kind of spinning our wheels for a couple months. Can we sit down and get your help? We said, absolutely. And then after we took them through our process, we sat down and did an investment strategy meeting. We were under contract here within, I think, a month or so. And like a lot of our properties, for rental properties, this one came off the MLS. So our 12-month average is 68% of our rental properties, we found them on the MLS. So the vast majority were from the MLS. So Preston, why don't you walk us through the details on this property?
So this one actually happened pretty quick. We worked with these clients, as you said, for a couple of weeks, just kind of analyzing properties and kind of going through the process and getting everything narrowed down. And finally, when we decided to go out and start looking at some properties, we picked a day and had 3 on our list, which is typically what we kind of like to do. That way we don't get analysis by paralysis and overwhelmed by looking at too many properties. So took an afternoon and went and looked at 3 properties that day, and this happened to be the first one I believe that we looked at. So went and looked at the other 2 and kind of saw what else was out there and circled back around and decided that this was the one that worked. We looked at the numbers, matched it to the spreadsheet. This property was in really, really good condition overall. It was on a slab foundation, so just a single level house, 3-bed, 2-bath overall in really good condition. And we looked at the rent numbers, and obviously with the location and everything going on there, it just made sense. So this property had been on the market for over 75 days, and I reached out, hey, obviously it looks like you've got a seller who's got a price in mind, and you guys have been sitting on the market for a while, and this was at a time when things were still really pretty hot out there. And we kind of put together our presentation with our offer and contract after chatting with the listing agent, and basically said, hey, this is what we think the house is worth. They had listed it at 330, and based on the comps and everything around, just kind of made a good case for what we thought the value of the house was. And after some conversations and going back and forth, the seller finally agreed to our purchase price of 315. So that was great, and that's just another part of what's good about working with our team and our ability to really see what the values are of properties. And like we've mentioned in other podcasts, we don't want our clients to overpay for anything. We want to make sure we're getting good value and market value for the properties that we're purchasing. So, based on the location, it was near the hospital. That checked off all the boxes for this investor profile, and we were able to put a deal together.
And talk about the contract here. What about, I know we got a contract here. What was the inspection like?
Yeah, so inspection overall was pretty good. Nothing we didn't really see other than some electrical issues that came up during the inspection. It looked like they'd done some handyman type electrical work there, and eventually, some of that stuff just doesn't always work out. So it needed a new water heater, just some deferred maintenance type items, but nothing that were really deterrents to our clients. The big concern was just trying to get some of the electrical stuff sorted. So once we got through that, we had an electrician come back out and look at all the electrical stuff and determine what really needed to be done. And we were able to work out a little bit of a concession with the seller and keep moving forward with the contract.
And so actually, I'm going to circle back around because you mentioned on something a minute ago that this was the very first time they went out to look at properties, and actually probably the very first property they looked at. Why did they pull the trigger? Because I know some people say never buy the first property look at, never buy the first 10 properties. What was different about them and our situation as to why they felt well moving forward?
Chris, I think a lot of that do with our clients and the education and setting the expectations and really helping people understand and figure out what type of property fits their profile and their comfort level and things like that. And, to be honest with you, we're starting to see an increasing amount of our clients making offers on, houses they see the first time we go out and look at them, or even, the very first house that we go look at. So I'd like to think that we're doing a pretty good job with our clients about setting those expectations, and, it just makes the whole process a lot easier for our clients and saves everybody a lot of time with being able to do that education and all that stuff up front and analyzing properties and really getting a feel for what we're going to look at and what those properties are going to be like in real life.
All right, so the financing on this property was they went with a conventional loan, so a 30-year fixed loan, and they put down 25% to get the best interest rates. When the appraisal came in, or when we did the appraisal, part of the contract agreement, we came in above asking price. So that's great. We were able to negotiate the price below their original list price, and the appraisal came in above asking. So I have on the PowerPoint that we did not have any seller concessions, but you said we got a little bit, Preston?
It wasn't much, but it was enough to make the buyers happy with everything. I know, we kind of went back and forth about what the overall needs were going to be with the electrical system. And, the seller was able to come back. I think they helped us out with like a home warranty, but it wasn't anything crazy, but it was enough to make everybody feel comfortable moving forward. And yeah.
And so since they put more than 20% down, they had no PMI, and they did not buy their interest rate down. So
it looks like we got a question from Aaron.
Yes.
You want to talk about our secret sauce?
Yeah, so Aaron's question says, love the secret sauce reference to getting under contract. Can you describe it generally, the process without divulging any of the sauce? That is a good question, and you did a really good job wording that. Preston, you can have a stab at that one.
Yeah, so, secret sauce, because this is typically kind of falls into my wheelhouse. It just comes down to being able to understand what the sellers are looking for and how that fits into what our buyer clients are after, and being able to create an offer that is a win-win for everybody. And that's something that we really strive to do. We want to make sure that everyone comes out feeling like they got a good deal out of, whatever process we're going through. And it's something that we've kind of put together over the years, and just have certain things and ways that we go about working with different clients to make everybody feel like they're getting a win-win out of this whole process.
Yeah, very well said, Preston. So moving on to the analysis here. So what we have on the PowerPoints now, if you guys can't see because you're listening to the audio, is I've plugged all the numbers into the spreadsheet that we use from Joe Massey, plugged the numbers and took a few screenshots. So if you want to see the numbers yourself, click on the show notes and we put these spreadsheet screenshots on the blog. You can always email us as well if you want to copy the spreadsheet, because we do remove the address from there, so you have the numbers if you want to play around with it. So I plugged in the basic details. We selected investment property. We are putting 25% down. We put in the purchase price of $315,000. They had acquisition cost of about $2,500. Their loan costs around $1,500. So altogether, their down payment was just under $79,000. So 25% of $315,000 is about $78,000 and change. And then their initial repair cost for the electrical work is about $1,500. So altogether, between the acquisition cost, your loan cost, the down payment, and what we consider the rent-ready cost, they were all in for about $84,000. And the reason we like to include initial repair cost or rent-ready cost, I use those words interchangeably, is because if you have to spend money to get the property rented or get the max amount of rent, we feel like you should include that in your analysis, because that's when you have to spend. That leaves your checking account, and therefore you're losing the opportunity cost. So we always like to look at, hey, great, we bought for this much, but then how much money do we have to put in there to get the property rented and bring in top dollar? So about $84,000 was their total investment. Their mortgage rate is at 4.5%, and they're doing a 30-year fixed mortgage. So the rent for this property is $1,995 a month, and we plugged in our usual variables of 3% vacancy, 3% annual rent increase, and 5% annual appreciation rate. The effective tax rate is around 25%. So looking at the monthly operating expenses and plugging those in, they are using property management. Now we put in 10% in our underwriting. Now, our property manager is actually charging them 7%, but we round up to 10% to help other associated costs with property management. Since this is a detached property, meaning there's no HOA and no common walls, we like to use 8% for monthly reserves. So that's basically 1 month's worth of rent. We're saying, hey, that's what you're going to need to set aside for general repairs and maintenance, and also just starting to build up that part of the bank account, because one day you will have to replace a water heater or pay a deductible on a roof or do some bigger item than just a couple dollars here for some small work. So there's no HOA. The real estate taxes are just over $2,500 for the year, and their annual property insurance was actually only $932. As far as all the utilities, water, sewer, trash, electric, that's all being paid by the tenant. And when it comes to taking care of the landscaping, so snow removal, mowing the lawn, that type of stuff, that's also the tenant's responsibility as well. So they did a really good job of having tenants take care of items, and also just minimizing their operating costs, so that way they can enjoy more cash flow. So going on to the next screenshot here, the total annual expenses is about $7,700. So that's all the items we just talked about. So if you take the rent minus those expenses, that leaves you with a net operating income of about $15,500. Now their monthly mortgage payment, and this is just for principal and interest, is just under $1,200 per month. And that's at a 4.5% interest rate. So if you annualize that, it's just over $14,000 a year. Now, if you subtract that from the NOI, the annual cash flow is just under $1,100 a year. So, really, what's that like, Preston? What's like $90 a month or so? So when you see numbers like this for a property like this, what's your reaction?
It's definitely lower than some of the numbers we see, and whatever we compare it to the condo units that we've analyzed, this is definitely quite a bit different. But for the profile of these investors and knowing, the upside and potential upside, especially, 5-10 years down the road, I think this is pretty average and on par with what we're going to find for the detached single family stuff, especially, knowing this price point, right? I mean, this is a pretty low price point for a detached single family home. So I think these numbers are actually pretty good, right around that 5% cap rate.
Yep. And you hit on something very important, that it matched the investors' profiles. They definitely not want an HOA, and they didn't have enough money saved up to go buy a multi-unit, since that would require quite a bit more money down. So they were very happy with a property like this, and they know in the long run this will make them, good money in cash flow as rents hopefully continue to increase and properties values hopefully continue to increase as well. So looking at the metrics, it's a 1.3% cash on cash return, and it's a 4.9% cap rate. So believe it or not, this is actually, better than a lot of the properties you see out there for detached properties. A lot of times those are, in the 4 to 4.5% cap rate range. Again, when we do real underwriting, including property management, repairs, and maintenance, so getting a detached property around a 5% cap rate is a very good deal in this current market. So overall, if you look at the return on investment quadrant, which is that visual guide we use from James Orr up in Fort Collins, they're getting an estimated 27% return on their money that very first year. Now, cash flow at a 1.3% return, that's the lowest percent in return. Now, if you look at the two things on the bottom of the quadrant, depreciation and debt pay down, depreciation is just under a 3% return, and debt pay down is about a 4.5% return. So if you add those two together, I mean, that is over 7% right there. So
that's
getting
guaranteed, Chris.
Yeah, I mean, it's guaranteed. And that's why, oh wow. I mean, Preston, have you gotten 7% in your retirement plan the last month?
Definitely not in the last month, Chris.
Yeah. And we say that because right now, we're a few weeks into the coronavirus, where the stock market has melted down. Now, we invest in stocks. We believe in it. We believe in the long-term stock market. But that's one of the reasons we like about real estate. And one of the points that people don't often talk about is that depreciation, no matter what happens to the real estate market, no matter if you have to drop the rents, no matter if prices go up or down, no matter if the property is vacant, you are still getting that guaranteed tax deduction from the federal government, and that ends up being a good amount of money. Now, also, as you pay your mortgage payment, and hopefully, that's really your tenants paying your mortgage payment through their rent, is they're also they're buying back equity every single month in their property. So look at the fact that, hey, yeah, we're making, basically $100 a month in cash flow, but then we're getting a 7% return on the rest of our money before we even consider appreciation. Overall, it's a very good use of their money, because you're still getting a pretty much certain double, or a pretty high chance of a double-digit return, and that's just a great thing we like about real estate. Now, of course, if that property appreciates, as I mentioned a minute ago, we are in the middle of the coronavirus pandemic right now in early April. So whatever happens to prices, in the long run, since they own it, it's on a 30-year fixed. In the long run, I expect that part of town to appreciate quite a bit. Hey, who knows, it may go down, it may go flat, but in the long run, with that location, that price point, what do you think that value will do, Preston?
Well, based on everything we've seen and all the data we have, Denver will always keep appreciating. We might have a few bumps in the road, but we know that eventually it's going to come back around, and we're still going to see, upside on appreciation, and especially in this part of town. I mean, there's so much development going on over here that I don't see really any reason where they're going to lose money on the appreciation side.
So just to wrap up this deal analysis, like I said, this was a good deal that matched our investors' criteria almost perfectly. So we're very happy about that, happy with the property. And something that I always like to look at as well, I don't mention it very often when we do the deal analyses, but I always like to look at what the operating expense ratio is. So that's, hey, what are all the property costs except for the mortgage debt? So your taxes, insurance, property management, repairs and maintenance, vacancy. What's that cost? And the way we underwrote it came out to a 32% operating expense ratio, and which is right in line with our market rule of thumb of a 33% operating expense ratio. So a 1% difference is negligible because 1% is not going to make or break anyone. So bottom line, it was a good property that fit their long-term real estate retirement planning goals. Preston, you got any closing thoughts here?
No, I think we covered it here, Chris. And the nice thing about this is the first investment property for these investors, and it was really nice to be able to kind of hit, I would say above a base hit for these guys. And they were able to get the property rented within a couple weeks of closing, which was really good for them. They've got a solid tenant in there now, and just putting money in the bank, and they're looking to go buy another one here soon.
Great. Well, everyone, thank you for listening. If you got questions on this deal, reach out. If you got questions on how to evaluate a property or you want to go out there and build a rental portfolio, reach out. That's what we do pretty much 7 days a week. So thank you for listening. And Preston, thanks for joining me.
Thanks, Chris.